Good afternoon, everybody. Welcome to Bidwell's Industrial Market Overview. When we set this date for the webinar, we obviously didn't know it would be the first day of a second national lockdown. So whilst this might have helped our viewing figures today, COVID and lockdowns have played into the hands of the industrial sector too, particularly for distribution. Throughout this period, industrial yields have remained robust. Investor demand has been sustained. Occupiers continue to occupy their space during the lockdowns and, more importantly, pay rent, which is becoming a rarity these days. In the Bidwells region, the industrial sector is quite varied, with the Port of Felixstowe, A14, M1 and A1 corridors serving the distribution sector. The flexibility of warehouse buildings has allowed the tech sector to use and adapt them for many R&D activities too. So today, we're going to take you through the markets that we operate in and explain some of the current trends. First up will be Sue Foxley and Malcolm White, our research team, to guide you through the latest market data. Then we've got Paddy Stanton, who will cover the big box market across the region, which has been particularly active over the last 6 months. And then Rob Beatson, Paul Davis and Will Jones will cover the Oxford, Cambridge, M1 corridor and Eastern region, followed by a Q&A. There is an opportunity at the bottom of your screen to give us questions. Please filter them through. We'll try to cover them at the end, and what we don't cover, we'll come back to you on a one-to-one basis. So if I could ask Sue to kick off, that would be great. Thanks very much.
Thanks, Saul, and good afternoon, everyone. So clearly, as Saul said, there's an awful lot of focus on the industrial sector at the moment. I'm guessing, or hoping, I guess, that I'm not the only person who made multiple online orders before 7 o'clock this morning. And this is, I suppose, what a lot of people have been focusing on is very much the online sales. Unfortunately, we're not through the crisis, so we don't know where this is going to end up, but it seems clear that aspects of retailing will have changed permanently, with implications for the industrial market, as we know. But as we also know, as Saul just mentioned, the ARC market is vastly more diverse than that, particularly in the ARC, but the industrial market generally. And during the pandemic, this has really been a significant aspect of terms of activity that we've seen. So if we look here, this is a survey that tracks the COVID impact on business in the UK generally. And what we can see is the more resilient sectors at the top of the screen there. So during the pandemic, really, those sectors, and particularly those outlined in red across the ARC, have been particularly important from an industrial side. So the information and communications, whether that's in data and quantum computing, we've had satellite genetic engineering, manufacturing. So all of those sectors are really important across the ARC, as well as the transport and storage. Just to illustrate that, at Oxford, we estimate around 40% of the science and tech floor space is in industrial stock. So it just shows the scale of it. And the guys later are going to talk about that in a little bit more detail. So this has significant implications for demand, for stock and specification, and of course, rents. So to talk about that in a bit more detail, I'm going to hand over now to Malcolm White, who will provide the analysis of the H1 market and then also bring us up to date for where we are now. Malcolm.
Thank you, Sue. And good afternoon, everybody. Just picking up on some of the things that both Saul and Sue alluded to. The Oxford Cambridge ARC industrial markets is really quite diverse in its nature. Obviously, at the centre of the ARC, we have the core distribution zone. Milton Keynes, Northampton, and running all the way down to probably newer markets that are starting to emerge at Bedford and the outskirts of Bedford. We then have Cambridge market, which has really changed quite significantly over the past 5 to 10 years, with the size of the market really sort of narrowing down and contracting as industrial sites have been put to alternative uses. And then on the Oxford side of the arc, we have the high-tech excellence with work going on at Harwell, Culham, and some of the major science parks in and around Oxford. I think perhaps one of the more interesting ones, and I know that that we'll certainly touch upon this in a lot more detail later, is this sort of emerging distribution sector that seems to be coming up and raising itself in to the east of Cambridge and out towards Felixstowe. Just touching on it, we've got about 300,000 square foot of industrial floor space across the region, and we've seen that increase by about 4% since 2005. If we could move on to the next slide, please. And just trying to understand where the concentration of that floor space really is, and perhaps where the growth in floor space has occurred. As you can see, about 60% of industrial floor space is in that core distribution area, what we're calling here the M1 South cluster. We've got about 4% of floor space in the Cambridge cluster, with 13% in Oxford. Probably the most significant growth we've seen over the past 10, 15 years has occurred in the emerging distribution market of Peterborough Suffolk cluster, where we've seen a 12% increase in floor space over the past 10, 15 years. Next slide, please. Now, the main markets that we really cover across the Oxford-Cambridge arc are the Norwich market, Cambridge, Milton Keynes, Northampton, and Oxford. And looking at those markets, they're the markets we collect regular data for. Looking at those markets going back the past 10, 12 years, we've seen a fairly steady and stable rate of take-up, particularly over the last 7 years, since 2013, where activity has been at or around long-run trend levels. Long-run trend levels being about 3.8 million square foot per annum. Obviously, those figures are very heavily dominated by that core distribution sector. And even in H1 2020, we saw a fairly robust performance out of the Oxbridge Arc market. Take up falling slightly below trend levels. Remember that bar that we've got in 2020 H1 is only 6 months, and it also ignores elements of what I like to call grey take up, where occupiers have taken back space that they'd previously put onto the market. Probably the two best examples of that are Tesco at Tectonic 620, where they reoccupied, I think possibly vacated and then reoccupied again, and they also took back MK 300. That million square foot or almost million square foot of grey take up is not included in the activity there. Also worth noting at the end of H1 that best part of 500,000 square foot across those 4 or 5 major markets was under offer. Next slide, please. And just looking at each of the individual markets, what activity levels they achieved in the first 6 months of the year, and how much of that was focused towards the big box market or market of 100,000 square foot and above. And just worth adding, majority of activity as we see there in that M1 South area, about 1 million square foot taking place, of which 560, half of that was in big box activity. Largest deal being the MK360, where M&S took the unit. Cambridge, interestingly enough, largest deal. Of that 90,000 square foot, we had 50,000 square foot of that in one deal, which I think was probably the last unit at of the new development at Buckingway Business Park. And Norwich, I think, an interesting example. Norwich, to some extent, has been hindered by a lack of availability of larger units. But what we did see, 145,000 square foot former Hiatra Seda unit was taken by Lotus, who concentrated or focused their manufacturing and research facility there. Next unit, please. Next slide, please. Just trying to bring it up to date, because of course we haven't collected our second half year statistics, but I'm just trying to bring up to date by focusing on what big box activity we've seen in Q3, and as again was alluded to by Saul, we've seen quite an active market since the end of H1. Oxford's a unit, 168,000 square foot, taken at Lignine Bicester, and I'm sure Rob will touch on the details of that a little bit later. M1 South Cluster, we've had a couple of deals. The final unit at Magna Park was taken by Royal Mail, magnitude 314, and I've also included in that Q3 figure an under offer at MK169, which I understand, and I'm sure Paul will be able to give more details, has gone to Amazon Fresh. Interesting things going on outside of that sort of core area, where we've got the Cambridge cluster. No big unit take up occurred, but we do have the Huai chip research and manufacturing unit, which received planning consent at the end of H1. Probably and this kind of reinforces the growth of the emerging distribution sector, where in the Peterborough and Suffolk cluster, we had 650,000 square foot, the new McCormick unit at Peterborough Gateway, which happened in the first quarter of the year. In Q3 so far, I think some of these deals may be under offer, but we've had 2.3 million square foot across 8 deals. And there's only one unit in Norwich on the market, or one short-term let available of a large big box facility, which is at Caxton Works. Only short-term let pending potential redevelopment. But even 100,000 square foot of that was taken during Q3. Next slide, please, Sue. And of course, all of this is sort of going on out. Availability rates have remained fairly stable, certainly over the past 2.5 years, edging around 6%. We've got about 6 million square foot of availability across our 4 or 5 main markets. Grade A supply about 1.2 million square foot, of which 3/4 of that is in the core distribution area the M1 South. In terms of big box units, again, predominantly focused in and around the M1 South area. These are big box units built and ready to occupy. 11 units across the arc as a whole, about 710,000 square foot of that in Grade A space. Next slide, please, Sue. And again, I'm only really focusing, when we're looking at this pipeline, I'm only really focusing on those 4 or 5 major markets that we cover. We've seen a fairly substantial tail off in spec development over the past 12, 18 months. I suppose unsurprisingly, given levels of uncertainty that there is around in the economy, and also due to the pandemic. Majority of spec development really focused in and around that Oxford high-tech specialist area. And the interesting thing about the buildings that seem to be going up there, probably the 2 largest at Didcot Quarter, both 100,000 square foot plus. The 120,000 square footer completed, I think, in Q1, but they're being marketed as 120,000 square foot distribution or R&D units. And I think that really gives us a flavour for the way that the Oxford market is tending to go. MK at the end of H1, only 275,000 square foot under construction. Next slide, please, Sue. And looking across the arc as a whole, whilst we've got an availability rate across the arc as a whole that sits at about 6%, we can see the various markets are really having quite different sorts of profiles. Whilst Oxford's at 8.6% availability, very little large big box space available there. Although just outside of we don't actually include Bicester within our industrial analysis for Oxford, but there are some big developments going up in the Bicester area, particularly at Symmetry Park and Link 9. M1 South, we've got availability down at 5.7% and Cambridge at 4.3%. Interestingly enough, the Norwich figure at 6.8%, with the short-term let at Caxton Works, we're going to see availability coming quite significantly there. And I think what you're tending to see, even in that Norwich market, you're tending to see an advance of larger requirements or requirements for larger units. Next slide, please, Sue. So what's happened on the demand side? Well, we've seen, we had a bit of a slowdown at the end of 2019, probably due to election uncertainty. But even given the pandemic, we've seen a fairly significant bounce back. Demand across our 5 main markets up at about 14.2 million square foot. Again, primarily focused in that M1 South or core distribution market, although there are quite a lot of significant large big box demand outside of Oxford, in and around Oxford. Although I think some of that demand is relatively footloose across certain elements of the southeast. Next slide, please, Sue. And I just want to show here that over the past 2 to 3 years, how we've really seen a surge in demand across our main markets for big box units. And again, this is not only driven by the core distribution area, also with Oxford, and even, although we're not necessarily tracking that demand, but we're starting to see increased level of demand out on that emerging distribution area. Next slide, please, sir. And just breaking that down across our major markets, we can see that of the 14 million, 50% of that in the N1 South area, with 71% of that 7 million square foot for 100,000 square foot and above units. Similar sort of story in Oxford, where we've got 5.6 million square foot of demand, and even greater proportion of the big box units demanded there. Cambridge, I think, an interesting market where some demand for larger units, but the majority of that demand really in that 20 to 50,000 square foot size brand. And in Norwich, this is a little bit out of date because it's the end of H1, and I think Will has, in my conversations with Will, who works out of the Norwich market, he's been saying that there's been an increase in big box demand in Norwich too. Next slide, please, sir. And of course, all of this has had quite a, I don't think the Oxbridge Arc is alone in this, but certainly we've seen some pretty impressive rates of growth in prime rental values over the past 3 to 5 years. I suppose the highlight or the figure that really catches the eye when we look across there, these major markets, is what's happened in Oxford, where rents over the past 3 years have grown by 9.2% per annum, and prime rents up at £14 a square foot. Even on a 5-year basis, most of those growth rates across all of the main ARC markets is looking very positive, and certainly a strong recommendation for looking at the sector within the ARC. But prime rents aren't the only rents that have moved forward. So if we can move on to the next slide, please. We can see similar sorts of figures have been achieved in the secondary market or good second-hand market, where Cambridge rents, due primarily, I think, to a lack of development going on in Cambridge, we've seen secondary rents move ahead very aggressively, particularly over the past 3 years. Where do we think rents are going to go? Sue, the next slide. Our views, we only forecast the prime rent series, and we've not been as aggressive as we've seen. I suppose every good story has to have a little bit of a slowdown. We're not expecting over the next 5 years to see the types of growth rates we've seen over the previous 5 years, but we've certainly got some very good expectations of growth coming through across all of those main markets. And certainly we may be underestimating where these figures are going to be, but particularly given the levels of demand that we're seeing. But even on these sort of growth rates, if you can buy into the market at current levels, it certainly makes an attractive option. Next slide, please, sir. I'm just sort of touching on here now investment activity. It's only a couple of slides, so I won't go into a great deal of detail, but pre-lockdown activity, and this is the sort of 5 months leading up to lockdown, we saw about £500 million worth of transactions in the Oxbridge Arc area. That has slowed significantly in the post-lockdown area, halved or less than halved. But what we've seen is that yields have remained fairly active. Looking across the markets, and the large figure yields that we've got here are the average yields on transactions that have taken place in each of those sub-markets over the past 12 months. So it's a bit of a moving feast, but you can compare also against prime yields that we've got underneath as to where the market is. Worthwhile saying that when we look at the Oxford market, I've included in the Oxford transactions the Harwell deals. There have been several deals at Harwell which have been achieved at quite, and they're almost like hybrid buildings, some of those, and out towards the better value area of the emerging distribution market, where 6.25% average on transactions, and that's probably based on 8 to 10 transactions. Average yields on transaction of 6.25%, but prime yields some way below that. Where in Peterborough for well let, big box units, and you're probably talking 5%. Next slide, please. So, and this is me sort of rounding off. I think the interesting thing on our levels of activity that we've seen over the past 12 months is how pre and post lockdown different types of investors played a more significant role. You can see in the pre-lockdown activity, UK institutions and overseas investors playing a significant role. Worthwhile saying that the overseas investment, the 264 million, was heavily influenced by the sale and leaseback of the B&M retail unit at Wixons in Bedford, transacted at 4.2%, was 154 million pounds. So that was quite a substantial contributor to overseas activity, bought by Decca. Post-lockdown, we've seen a slowdown. We've also seen an easing in the levels of activity that UK institutions have been playing in the sector. But we have seen some of the property companies coming to the fore, accounting for about 30% of all activity in that post-lockdown era. And just focusing on the last thing, just to sort of finish off here, what I found quite interesting, and again, this is only the average yield on transactions, but pre-lockdown average yield on transactions was about 5.55%. Post-lockdown, even though activity levels are down, we've seen average transaction yields come in. And I found that quite surprising, I suppose. It certainly surprised me, but I guess given the favourable view towards the industrial sector, what we're seeing is greater competition, or still good competition for most industrial units. That's pretty much me at the moment. I think now we're going to hand over to the individual teams to talk about their sectors. Thank you very much.
Thanks, Malcolm. Paddy, you are there. Excellent.
Thank you, Sue and Malcolm. Some very interesting stats there, and good afternoon, everyone. Thank you for taking time this afternoon to come and listen to our little webinar. The most pleasing thing from my perspective so far is that we've beaten the number of attendees from the office webinar. So thankfully, it looks like we are now no longer the ugly duckling, and probably more of the swan sector, which is pleasing for me to hear anyway. I've just been asked to say a few words. Malcolm touched on it there, but the new emerging big box market that we're seeing across our patch at the moment, which effectively is the area running from sort of Peterborough down the A1 to Biggleswade and across the A14 towards Felixstowe and Bury St Edmunds. Given the appetite that everyone seems to be wanting to listen to big box webinars and conversations at the moment, we didn't want to disappoint. I'm going to talk about two schemes to start with, which are driving both those markets, where most of the take-up has happened on those two schemes, and then just touching upon 3 or 4 key deals that we've been involved in on the bigger box side. And by bigger box, I mean anything sort of over 100,000 square feet is what we classify in our numbers and statistics for that. The only stat that I'm going to bore you with which Malcolm mentioned, is that there has been 2.8 million square foot of take up in that emerging market. And Bidwell's have actually been involved in 2.2 million square feet of that. So it's more just a nice shameless plug for us and a little bit of a good soundbite to take away from this webinar if you don't take anything else away. The first slide on there, which Sue's already put up, is the JANIX scheme at Suffolk Park, Bury St Edmunds. This scheme in particular has had quite an incredible 12 to 18 months, culminating in approximately 1.5 million square feet of take up during that period. The most recent of that is the big box you can see in the left-hand side, which has been announced this week, which is an 870,000 square foot transaction to the Wirtz Group, which we've analysed as being the largest transactional square footage wise for the last 15 years across the region. So when you compare, I think the next largest is around 600,000 square feet. It really kind of sets it apart as a one-off transaction and a great result for the scheme and the area. I think it gives a real statement for the A14 corridor in terms of what is being accomplished. And Malcolm and I were talking earlier that one of the reasons we think for that is that the east and the draw of Felixstowe Port is dragging people closer to the eastern region as opposed to having to be in the centre of the Golden Triangle. Given the connectivity links of the upgraded A14, you can get to a hell of a lot of the UK within a 4-hour drive time from these areas now, as opposed to maybe 5-6 years ago where everyone wanted to be the Daventries and Northamptons of this world. It's worth just touching upon the Unipark Group deal, which is a 150,000 square foot building you can see in the middle of the scheme. We let that probably 15 months ago to Unipark on a 20-year lease, break at 15, and subsequently we sold the investment to Savills IM for 4.75%, which again I think just highlights the investor confidence that's also in the A14 and the emerging markets. We are hitting some fairly sharp yields for well-let big box accommodation, and it doesn't seem to be off-putting that it's in East Anglia as opposed to on the M1 corridor. Next slide, please, Sue. So this slide actually only shows half of Peterborough Gateway. There's almost a replica image to the east of this as well, but this is the best shot we had at the moment. This is a development by Newlands, who in a joint venture agreement with Milton Estate, who had the initial 550 acres. We brought Newlands in, or Roxhill as it was then, back in 2010 to deliver the infrastructure and create the park that it is today. There have been some really significant transactions that have happened this year. Malcolm mentioned earlier, McCormick purchased 24 acres for their manufacturing and distribution warehouse of 640,000 square feet they're going to be creating in 2 phases. And Urban Outfitters have completed 450,000 square foot for their UK distribution facility. Again, they were looking potentially M1 corridor, but due to the availability of labour and slightly competitive rents in the Peterborough area, they've decided to choose this as a location and have just completed their construction. The slide actually shows the 2 recently PC'd buildings, G226 and G385, very aptly named. I'll let you guys guess how big they both are. They've been developed by Newlands and funded speculatively by Bethnal Greenoak, and they PC'd 3 weeks ago, and are available on the market. And it's worth just pointing out that given the crazy 9 months that we've had in terms of take-up statistics in this emerging market, these 2 buildings represent the only available buildings over 100,000 square feet across that whole market. And there's currently nothing competing and that's under construction speculatively coming out of the ground in that area, which is absolutely unprecedented to have such limited availability across the patch at any one time. There are 2 or 3 schemes that are waiting in the wings that have got planning applications pending, or infrastructure looking to go in, but at present these are the 2 only available buildings. And the last slide, please, Sue. I just thought it'd be quite good to put a few transactions on. Everyone likes hearing about what deals have actually been happening rather than the number of them. So there's 4 that we've been involved in here, starting with the top left. This is a warehouse in Sawston, just south of Cambridge. Slightly secondary, but quite an interesting story in that the whole site was actually purchased by Huawei 2 years ago. We sold 550 acres to them for their UK manufacturing facility. We acted for the tenant on this, letting it to them when it was for its previous owner, and we've just surrendered it back to Huawei because in the north of the picture there, they're going to be building a 300,000 square foot R&D facility, and phase 2 will be knocking down this building and building their next building on it, should the government allow them to keep trading in the UK and they not be booted out. So fingers crossed for them on that one. To the top right, this is an investment sale that Saul and I are involved in at the moment, acting on behalf of DHL. It's a sale and lease back in Stanton, fantastically named town, just to the north of Bury St Edmunds. We have just put this under offer and we're hoping to get this completed by Christmas, but we were very encouraged by the amount of activity we had, receiving 7 bids for the site in a 3.5 week period of marketing. The bottom 2 slides there are actually for the same US client, Dart Products, who make or made plastic cups for Starbucks and Costa. Due to the sort of headwinds surrounding plastic activity and manufacturing, they've decided to decant from the UK, and these 2 were surplus to requirements. The Huntingdon facility is 110,000 square feet, 130,000 square feet, sorry. We've sold this selling this to a developer who's looking to fully refurbish the building and given the confidence in the occupational market, taking a bit of a view, but has already got some good interest in occupying the 120,000 square feet that'll be left there. And Kingston 189, we've actually surrendered Dart's lease on this one and have agreed a new 10-year lease with Taylor Wimpey as of 2 weeks ago, and they will be taking that for their UK distribution facility. So again, they had pick of the UK and chose Peterborough for their storage of doors and doorknobs and sinks, etc. So they will be using that as their central UK hub. So as I say, it's a very brief run through of the market. I'm happy to take any questions afterwards, or do give me a call to have a conversation about things. I think a couple of key points to take away. One, there has been, as Malcolm mentions, a huge increase in demand for the A14 and A1 corridors for various reasons. I think it's down to employment, the competitive edge that there might be compared to the M1. We've also seen, as I said, Felixstowe being a real pull for occupiers. The likes of MH Star, Wirtz, a lot of their kit comes in through Felixstowe, and being close to the port to store and distribute and then go from there to the rest of the UK has been a real driving force when speaking to those occupiers. Looking at the supply shortage, 2021 could be a challenging year given there's only 2 buildings currently available. As I mentioned, the next phase of speculative development isn't in the pipeline as yet. There are some sites that have got planning. We do have some land left at Suffolk Park, but once that's gone, we're probably 2-3 years away from seeing another Peterborough Gateway or a Suffolk Park. I trust that's been helpful. I will now hand back to Sue, I think, who will move on to the more regional markets.
Thanks, Paddy. Rob, are you there and unmuted?
I see. Yeah. Good afternoon, everyone. So perhaps you can just move on to the first slide, I think. So as with many industrial markets across the UK during 2020, the Oxfordshire market has been driven in part by demand for these big box logistics facilities. Although, as Malcolm said, as in Oxfordshire, we're now seeing those facilities being pitched at both distribution users as well as high-tech operators. And the deal that Malcolm actually mentioned in Bicester was to rival an electronic vehicle manufacturer who planned to open a plant to build electric vans, having received a bulk order from UPS for 10,000 units. As Malcolm has already alluded to, in the context of the ARC, what is interesting is the increasing demand within Oxfordshire, and in fact it's reflective of what's happening in Cambridge as well for industrial type stock from the science and tech sector. And this is not just within advanced manufacturing and engineering and aerospace, which previously led demand, but across all sectors, including life sciences and quantum computing. Despite the disruption of COVID to business activities, we've seen record levels of fundraising take place this year for Oxfordshire's science and tech community. Oxford University Innovation, who are a subsidiary of the university who effectively support spin-outs, reported in September that a staggering $1 billion has been raised so far this year for their portfolio companies. And this is record breaking. The levels like this has not been seen before, and is really what's driving demand for real estate within Oxfordshire. What we've seen during 2020, driven in part really, I think, by a lack of laboratory space available in the market, which has meant that these organisations have then had to try and deliver that type of space themselves. There's been a preference to acquire hybrid type industrial units as opposed to more traditional office space. There are a number of reasons why this is the case. Firstly, and perhaps most obviously, is the lower cost of occupancy. We're seeing office rents in the city centre sit at around £35 a square foot, whereas rents for industrial stock within the ring road are at £12 a square foot for a modern unit. Secondly, the greater flexibility and ease for fit out. An industrial unit effectively gives a blank canvas to an occupier. It doesn't require difficult structural alterations for plant, which can be the case in some office buildings and is critical when looking at a lab fit out. And also the lower reinstatement cost of stripping out an industrial unit as opposed to an office is also a consideration. I think thirdly, that the point around why these type of occupiers are preferring an industrial type product is that they can effectively carry out all of their activities under one roof. So they can have a front of house function. So as you can see within the picture, this is the Zephyr building down on the Harwell campus. And that front of house, the units look great. So you can have your investors coming to meetings, you can attract staff, but then you also have that back of house function for R&D and production and manufacturing. So you really have everything under one roof. Whilst COVID has undoubtedly caused both economic and business disruption in Oxfordshire as across the whole of the UK, it has also provided Oxford global recognition as one of the key locations in the world for developing a cure. And this has been further enhanced by the decision taken during the summer to fast track the building of the Vaccines Manufacturing and Innovation Centre on the Harwell campus, with the new 75,000 square foot facility now due to open in the summer of next year. And what we've seen is undoubtedly an increase in interest from landlords in the life sciences sector following the pandemic, and more generally in the science and tech sector as a whole. As one client, actually on the occupier side, was talking to, said, you can't do chemistry in your kitchen. And this sums it up quite nicely. And landlords now have an expectation of a higher resilience of occupation from businesses within the sector. In regards to new supply coming into the market, we're now seeing a trend towards delivering a more mid-tech type offering, with developers now aiming at attracting these science and tech operators as opposed to more traditional industrial occupiers. And this is seen in consideration given to such things as the visual aspect of units with high quality cladding, glazing and internal finishes, as well as wider estate landscaping and amenity provision. In addition, elements such as power and data provision, which is critical to the science and tech operators, have also been given consideration. So if you could just move to the next slide, please. So in Oxfordshire, the Harwell campus has really been one of the market leaders over the last few years in terms of delivering these type of hybrid products. And now on their third iteration, being the 60,000 square foot Zeus development, which you can see in the CGI, which is due to complete in December. If you could then flick to the next slide, please, Sue. The Oxford Technology Park will also be delivering around 80,000 square feet of hybrid space split across 3 units in 2021. And in fact, people may have seen announced yesterday that with Bidwell's advising, they've just signed a pre-lease on a 50,000 square foot unit to a company called Native Antigen, who are a biotech company expanding in Oxfordshire. The Oxford Business Park are also looking to deliver 2 hybrid units of 60,000 square feet with delivery Q4 next year. And this is within the ring road, which is interesting because there really is no space like that at the moment within that location. And up in Bicester, Albion Land have released details of the Catalyst, which is a 300,000 square foot scheme aimed at attracting technology, advanced manufacturing and high performance engineering companies to the growing cluster that's developing in Bicester, and which Arrival, as mentioned at the beginning, are sort of leading on. So this new supply will undoubtedly be welcomed by the market, and with the scale of investment coming into the science and tech sector in Oxfordshire, it is likely that demand will remain strong. And despite wider economic disruption, as Malcolm said earlier, we forecast that we'll see strong rental growth within the market, both within the prime new stock, but also within secondary stock as well. There's a bit of a canter through an overview of the Oxfordshire market, but I'll pass you over to Paul now, who will just talk through Milton Keynes.
Thanks, Rob. Are you there, Paul? We're running a little bit over, everyone, but hopefully you can stick with us. We wanted to cover a little bit further. Excellent, thank you.
Don't worry, so I'll keep it short and sweet. Just in respect of sort of Milton Keynes, we all heard about the big box activity and that sort of thing, so I won't dwell on that any longer. What I've noticed is from coming out of lockdown, there has been strong activity across all the size sectors up to sort of 100,000 square feet or so, which has culminated in a lot of deals going through recently. There was an awful lot of pent-up demand at the end of lockdown, which is all concluding currently. A few things we've noticed recently from that, and obviously we have some good occupiers in Milton Keynes in the sort of the high-tech automotive industry. We've obviously got Red Bull that are on the charge at Tilbrook, and they seem to, as soon as a building comes available there, they seem to snap it up. But off the back of that, there are an awful lot of smaller businesses that sort of tap into Red Bull and supply precision engineering parts and that sort of stuff for them. And there's a big draw into Milton Keynes from that side of things. We've got the new HQ for BP Charge, and there's now a draw for sort of suppliers on the electrical cars and that sort of stuff coming through as well. And with Silverstone down the road, you know, they're obviously expanding there, but there's draw from that sort of sector as well. So there's an awfully big surge on the sort of the high-tech side of things. The picture that Sue's popped up there of Murdoch Court, this was a spec-built scheme in Milton Keynes. It was sort of between two horses, where it was designed around small unit schemes, hence the number of loading doors there, as you can see from there. And it was that particular block was 28,000 square feet, which was capable of being subdivided into about 6 different units. We've actually got that one away now to a single occupier on the logistics side of things, but it works perfectly for them with all the loading bay doors, etc., that we've got in the unit there, and we've just put some offices in there for them at the one end. If you could move on to the next slide, Sue, as well. Yeah, this is another spec-built unit, not in MK, but in the near vicinity over at Leighton Buzzard, which was 50,000 square feet. Again, that has recently been let post-lockdown to a logistics operator that was looking to expand to another site as close to Milton Keynes as they could get, Luprian. So that deal's been done recently as well. I think it's fair to say that another driver that we're noticing on trends wise is with Milton Keynes being slap bang on the M1, great sort of from a logistics point of view, but with our rental levels as we are at sort of good second-hand refurb space at sort of 750 a square foot, a new build touching the sort of 850, 875 mark, we're actually seeing it's quite competitive for those guys that are wanting to come out of the M25 areas now, where rental levels down there are sort of fully in double digits. So we're looking at quite cost effective compared to those locations, and we are seeing sort of a driver going forwards in that regard, which is good, which is taking place. We've got other sort of things to look at in respect of supply. As the units come back, they get sort of seeing that there isn't a rise in supply at the moment. We are seeing some new schemes coming out of the ground, or will be coming out of the ground, which is repurposing of older buildings. Gaisley have just got planning consent for a site down at Foxmill, which had a unit of about 140 to 150,000 square foot on it that DHL had. They are going to knock that down and expand the site out to 240,000 square feet over 2 units with about 120,000 square feet. So those are the sort of the opportunities that we're seeing coming forward now, because the sort of the available land at the moment in Milton Keynes, there isn't a great deal of it left around. MKDP still control a couple of sites, but at the moment they are not selling those sites. They're looking to develop them out themselves. So it's sort of it's looking at other opportunities to bring land forward, and obviously promoting of greenfield opportunities. I think I'll leave it there. As I said, I'll do it short and sweet as we're overrunning a little bit. And I think we're now handing over via Sue to Will in Norwich. Thanks very much.
Thanks, Paul.
Yes, good afternoon, everyone. I can't quite work out whether I'm the headline act being last on, or I've been handed the graveyard shift as people slowly begin to drift off. So I won't cant. I will gallop through what is going on in the Norwich market. Just rewinding back to the end of H1, as Malcolm said, take up was 280,000 square feet. And interesting, that was the same figure for the whole of last year. And in addition to the Lotus deal that Malcolm mentioned, there was another large deal of 40,000 square feet to another automotive industry person, Quentor, who took space at Lansdowne Road up at Union Park. The supply of the available units had held pretty firm at just over 730,000 square feet, but at that time it included the 200,000 square feet at Carrow Works, not Cacton Works, Malcolm, which we were offering short term as part of the former Britvic site, which is being sold subject to planning. And out of the 450,000 square feet of demand, that consisted of 33 active requirements. So what has happened since that time? Well, the market has continued very much in the same vein. Demand remains strong, particularly at the larger end of the size range and for freeholds, and the supply of the better quality units in particular is falling. So just really sort of picking up on a few key factors or themes for the market now. Firstly, and again, as Malcolm alluded to, the requirements have got a lot larger. It used to be the case that a large requirement for Norwich was typically only 50 or 60,000 square feet, and we've now got 4 requirements over 100,000 square feet. And of course, there was the Lotus deal. And most of these requirements are being driven by the pandemic, so are from the online retailers and the delivery companies. Rents have also risen. So at the end of the first half, we reported prime rents as being £7 a foot. In July, we let a unit on the White Lodge trading estate at £7.25 a foot. And interestingly, we have a brand new 20,000 square foot unit down at Gateway 11 on the A11 just to the south of Norwich, which actually was the first speculative building for probably well over 10 years. And we're close to putting this under offer at the asking rent of £8.50 a foot. So just looking at that previous slide, it could well be the case that the rent of £8.50 is a 2021 figure as opposed to a 2023 figure. Vacancy rates on a number of the industrial estates are now at historically low levels. And again, there's a real shortage of anything of any quality, probably over about 20,000 square feet now. In terms of large recent deals, I guess the main one is the one at Kero Works, where BT Passive are now in occupation of getting on to close to 100,000 square feet. And again, BT Passive are a good example of a company whose business has grown as a result of the pandemic. They basically make passive houses and have a number of contracts with the London boroughs to house homeless people. So if you could just, thank you. So finally, just touching on a few new schemes. The slide that you can see in front of you is the proposed new units at White Lodge Trading Estate on the south side of the city. The former Marsh storage unit has now been demolished, and the CGI you can see is of 4 new units ranging in size from 15,500 square feet to 26,000 square feet, and totaling about 75,000 square feet. And the chances are the Crown will hopefully be on site at some point in the new year to build those on a speculative basis, although we already have a decent level of interest. There is the Chancery Gate Diamond Point scheme on Vulcan Road, which I'm sure a number of you are aware of. This was actually put on hold when the first lockdown happened, but Chancery Gate is still keen for us to find a pre-let or pre-sale of one of the larger 3 units at the front, which range in size again from about 15,000 square feet up to 20,000 square feet. And lastly, Norfolk Land Developments have now started building 7 trade counter units out at Broadland Gate. These will range in size from 4,300 to about 6,600 and should be completed by the end of May next year. That's it. Thank you.
Apologies. So thank you very much for sticking with us. We ran over and I do apologise for that, but there's a lot to obviously cover in the market, and I think we've only lost about 2 people due to the running over, so thank you. There's a couple of questions there. We've gone back on most of them, I think privately, and we can do that. There's a couple more complicated ones. I think probably just because of time, we'll need to go back to you privately, but if you think of anything afterwards, then of course do drop us an email or any of the team there. I think what I really just wanted to say is hopefully you can kind of get a feel for both the scale of the market and the level of activity and the diversity that's operating across the arc in the industrial market. It's certainly not just one market at all, but that does really come with its challenges. A 4% availability rate in Cambridge is not really sustainable for the market, and actually in an engineering and tech side of things, actually that just hinders growth and it curtails activity. So we need supply in that respect. And finally, thank you very much for joining us today. Thanks to the team here, thanks to the marketing team for putting this together and bearing with us. I hope you'll join us for further webinars. There's a few more coming up, so we'd love to see you. And in the meantime, do stay safe and have a good evening. Thank you.